On the program today, Zambian Finance Minister says bondholders to blame for default. Moody's Investor Service affirms African Development Bank's AAA credit rating. And Nigeria's inflation rate rises to 14.23% in October. Thank you for joining us and welcome to Business Incorporated. I'm Chimeze Obi Iwagu. We'll begin here in Nigeria as the inflation number went up to 14.23% year-on-year in October. This is 0.52% points higher than the rate recorded in September. Data released today by the National Bureau of Statistics shows on a month-on-month basis, the headline index increased to 1.54% in October 2020, 0.06% rate higher than the rate recorded in September. The composite food index rose to 17.38% compared to 16.66%. The rise in the food index was caused by increases in prices of bread and cereals, potatoes, yam, and other tubers. On month-on-month basis, the food sub-index increased by 1.96% in October, up by 0.08% points from the figure recorded in September. The all items less farm produce or core inflation, which excludes the prices of volatile agricultural produce, stood at 11.14%. And to markets, the dampening inflation numbers did not deter investors who have found a safe haven in the Nigerian stock market, as the index was in the green, 0.20% at intraday. The JSE index in South Africa was also in the green, up 0.35%. Egypt was not left out. The EGX30 was up 0.28%. Kenya closed positive on Friday. And the week also started good in the Middle East as all the indices were in the green at intraday. The UAE, the Abu Dhabi index notched up 1.64% to lead Dubai financial market, which also was trading up 1.32% at intraday. Elsewhere in the region, the Qatari index was up 0.24%, while the Saudi Arabia's index traded marginally high at intraday. In Europe, stocks advanced in early trade as the fallout of the U.S. election in early November and the coronavirus pandemic remain in focus for global markets. Let's hear more from Chelsea. Hello, Chelsea. Good afternoon there. Well, let's start off with markets. After last week's big rally has left many global stock indices near record highs. Do investors in Frankfurt see this rally continuing?
There's definitely a lot of reasons to be positive on markets, especially right now. We just a few minutes ago got news from Moderna, another pharmaceutical maker that's been one of the front runners in this race for a corona vaccine. They're reporting with early results that they have their vaccine candidate is proving to be about 95% effective. That's really a very high rate of effectiveness. A lot of scientists had been expecting something closer to 50% in terms of efficacy for these coronavirus vaccines. And we saw last week also results from Pfizer and BioNTech that their vaccine candidate is about the same, at about 90% effectiveness. So this is obviously very good news. It suggests that we might have not just one, but potentially two coronavirus vaccines that could begin to be distributed in the next few weeks, potentially by the end of the year. Moderna is also planning to submit its drug candidate for approval quite soon. So that's definitely giving investors a bit of optimism to start the week off after we saw these big results from Pfizer last week. I think it is notable today that we're not seeing such a strong reaction in the stock market. When Pfizer released its results a week ago, we saw the stock market shoot up 5% in the mid-single digits. Right now, the DAX in Frankfurt is up only about 1%. So I think investors are keeping in mind that even with these positive vaccine results, even with a potential approval coming quite near, it likely will take several months for this drug to really be distributed to a large part of the population.
In the meantime, German Chancellor Angela Merkel is meeting today with state premiers to discuss the rising number of coronavirus cases. The country is already in lockdown light, but could new restrictions be coming?
it's very likely that we will see Chancellor Merkel and the state premiers decide on further restrictions. As you mentioned, we've already been in a partial lockdown for about 2 weeks. That has included things like the closure of bars and restaurants, museums, cinemas, but we still do have many workplaces open. Schools remain open for the most part, as well as most retail establishments, so stores, things like that, have remained open. What the government leaders are expected to decide on today is really further contact restrictions. So there already are limits on the number of people that citizens here are allowed to meet. They're likely to make those rules stricter as we do see the number of cases continue to climb, especially as we head into the holiday period. We've heard from a number of officials across Germany, but also Europe as well, that they want to keep Christmas open. So now is really the time to be tightening restrictions if they want a hope of having a brighter Christmas.
In another development, a group of privacy activists have filed a complaint with German and Spanish data protection authorities over Apple's online tracking tools. Walk us through this complaint.
So this complaint was filed by an Austrian-based privacy group led by Max Schrems, who's been really the driving force behind a lot of EU data privacy complaints. He's filed at least 2 large and widely watched complaints against Facebook. So now Apple is clearly in his crosshairs here. What he and this group are alleging is that part of the code that's automatically downloaded onto iPhones. So if you buy an iPhone, it's already pre-downloaded on it. It's this code that basically allows Apple and advertisers to track you across the internet and across geographic locations. So if you're searching for something, if you're going somewhere, they're able to use this code, which is sort of like the digital version of a license plate, to see what you're doing, to see what you're looking at. So what this group is saying is that is in direct violation of EU law, because users aren't able to say yes or no to this. There's no consent in the process for Apple in this. So that's what they say is against the law. In the past, some of these complaints have taken a very long time to see a result in court, but this complaint is going a bit around normal law. It's being filed under a very old piece of EU law, so they're optimistic that they could potentially see an outcome quite soon.
All right, Chelsea. Well, the week has just started, and I'm sure we have quite a lot to monitor in the week, particularly with the prospects and the vaccine for the coronavirus pandemic. Hopefully, something positive, of course, will come out of it. Thank you, and enjoy the rest of the day. And after its best week since April, the UK stock market is beginning the new week on the front foot. The broader FTSE 100 opened up in the morning. Let's get an update from Juliana in London. Hello, Juliana. Good afternoon. Well, shares in travel and hospitality companies, miners and banks are on the rise as traders continue to price in a vaccine-led recovery in 2021. Bring us up to speed with market data this intraday.
Well, the FTSE remains in positive territory at intraday. It appears as if, as you were just discussing in Frankfurt, a lot of the hope of investors is on a new vaccine. In fact, we had a little bit of development here in Britain, and that's that the Johnson & Johnson vaccination trial has gone into its 3rd phase, and they have 6,000 volunteers. So as well as doubling up on the doses of this Pfizer and BioNTech vaccine, the British government have got this well under control, and investors were rallying on that news. As you were saying, lots of bounce back stocks are doing still pretty well at intraday. IAG, the British Airways owner, their shares are up 6.8%. Rolls-Royce are up 6.2%. Melrose Industries are up by 6%. Lots of the banks are doing pretty well at intraday too. Just having a look at those numbers, the FTSE All Share is up 0.67%. The FTSE 100 is up by 0.73%. And the FTSE 250 is up by 0.93%. In currencies, the pound down on the US dollar by 0.18%, down on the euro by 0.23%, and down on the Japanese yen by 0.12% at intraday, Chime.
And 8 months since the lockdown forced the temporary closures of businesses, thousands are still awaiting payouts from their insurance. Now, the Supreme Court will today begin a 4-day appeal hearing in a test case brought by the Financial Conduct Authority against 8 insurers. But many insurers disputed the claims. What is their argument?
Well, their argument is COVID and the fact that, COVID is something that insurance companies just weren't able to foresee. But that's not good enough for the Financial Conduct Authority. As you said, this is a pretty rare case, and it's very rare for a regulator to step in on behalf of policyholders. But the FCA do feel as if these 200,000 business owners have been completely maltreated by insurance companies. I believe there are about 6 that are in question. And in actual fact, in September, the FCA did actually win the case. The judge did believe that any policy holder that had a business interruption policy within their scheme was entitled to a payout for lost earnings. They wouldn't have been getting as much back as they had lost, but certainly this payout by the insurance company would have definitely cushioned the blow. But when the judge did make the ruling in September, I believe 6 of 8 insurers decided to appeal. So the appeal process has started at the Supreme Court today, and the FCA again are backing these insurance policy holders. I've got a statement here from one of the lawyers involved, Stephen Mead at Capital Law. He says insurers are just using different tactics to hold off payment. We see them continue to refuse payout on charges relating to policies which were not included in the test case. Insurers are also making deductions for some types of government support received by policyholders during lockdown. Ultimately, this is a case of decency, and that's really the overwhelming question. A lot of these business holders, business owners, they have these insurance policies, of course, paying for years, some of them every single month. As soon as they're in a crisis, the insurance company are pleading foul play. But as I said, the FCA are doing this as a test case. They are taking this forward. They have already won, and so they're hoping to be successful at the end of this 4-day appeal. And then we're expecting a payout of something like £1 billion, which will definitely be historic and a monumental decision.
And in another development, Boris Johnson is understood to be planning to ban the sale of new petrol and diesel cars within a decade, with reports that the ban will be brought forward by 5 years. What are you hearing about this move?
Oh, well, initially, just pre-COVID, in the world pre-COVID, Boris Johnson did decide that he wanted to put this ban on any new petrol and diesel cars from 2040 to 2035. We've been hearing reports from Downing Street officials that now, this week, he will cut that even further to 2030. And it's all part of the British government's big plan to decrease their net zero emissions, in fact, to cut them to zero by 2050. And they want to make some of these really big announcements on next year during COP26, which is the UN's climate emergency gathering. It was supposed to take place this month, I believe, in the north of England. But of course, COVID-19 has spoiled all of those plans. But it is still to take place next year. And Britain certainly want to be seen as one of the leaders in trying to tackle the climate emergency head on. We have actually heard from the Society of Motor and Trade. They believe for this to be a reality that the government need to put in more incentives. We've certainly seen across Europe, particularly in Britain, that the use of electric cars is growing. But just last month, only 7% of new cars that were purchased in this country were electric vehicles. So there's still a long way to go. And so there are calls for the government to put more infrastructure and incentives in place so they can actually reach this pretty ambitious target.
All right, Juliana, let's continue to track some of those developments, particularly on the vaccine findings. Enjoy the rest of the day.
Thank you.
In Asia, markets bounced in Monday's session after 15 economies in the region signed a deal that formed the world's largest trade alliance, tech and auto stocks soared. The trade deal signed on Sunday aims to gradually reduce tariffs across many areas. The Regional Comprehensive Economic Partnership is now the world's largest trade bloc, a deal that excludes the U.S. It marks the first time that fast Asian powers, China, Japan, and South Korea, are in a single trade agreement. We'll take a break, and then when we come back, Zambia on the brink of a debt default. What's the implications? We'll talk about that when we get back. And Zambia's finance minister has blamed bondholders for last week's default upon saying they refused to sign confidentiality agreements that would have allowed him to share more information on debts from Chinese lenders. Zambia on Friday missed a $42.5 million interest payment on one of its Eurobonds, becoming Africa's first pandemic-era sovereign default. The default was unavoidable because the country, which had received some debt relief from Chinese lenders, had to treat all creditors equally. What is the implication of this? Matt Kiniger, an associate practice lead, Sub-Saharan Africa at Docker Frontier, will tell us. Hello, Matt. Good to see you. Good afternoon.
Hello, good afternoon. Thank you for having me on the program.
Now, you have been covering Sub-Saharan Africa for a while. From the early 2000s, Zambia was one of Africa's fastest growing markets. How has Zambia ended up in this position where it can no longer afford to service its debts?
Yes, so Zambia has been, or it was one of Sub-Saharan Africa's fastest growing markets, especially from the early to mid 2000s. It really benefited from very strong copper prices that drove export revenues. And so what the Zambian government did was it borrowed quite heavily when times were good. Debt was quite sustainable when the economy was growing rapidly. But what we've seen is that the economy has slowed as global copper prices have fallen. The problem, one of the major problems is that ideally the money that was borrowed from China and from private investors via Eurobonds would have been invested into infrastructure to support longer-term economic growth. But we don't really know where this money has gone. And this has meant that as economic growth has slowed, as global copper prices have fallen, and most recently with the COVID-19 pandemic that has caused economic growth to really weaken, the government really lacks the capacity to stimulate its economy. Unfortunately, Zambia really hasn't made the most of the funds that were made available to it through borrowing. So it really finds itself in a difficult position.
Now, Matt, in practical terms, how will businesses operated in Zambia be affected by this default, over the coming months?
Yes, I think this is probably going to be the biggest question that businesses want to know. So how will it affect them? So I think it's worth noting that a meaningful restructuring of Zambia's debt is probably quite unlikely over the coming months. And this is because one of the major ways out of this situation is through an IMF financing package. Now, the Zambian government is probably going to resist engaging with the IMF because the IMF will probably impose, or would probably impose, quite severe, painful austerity measures if they were to enter into an agreement with Zambia. This means that this situation will likely continue for a number of months in terms of the country remaining in default. So businesses will probably see more kwacha volatility as sentiment around Zambia worsens. We're probably going to see much weaker public spending over the next couple of months, but also much weaker private sector investment as access to credit gets worse. And issues around currency or capital outflows from Zambia gets worse over the next few months. So I think it's going to be quite a painful couple of months for businesses in Zambia.
Now, there is growing concerns about debt sustainability across Sub-Saharan Africa, given the impact of the COVID-19 pandemic on public finances. Are all the countries on the continent likely to follow Zambia into default?
Yeah, so rising public debt is really a concern across the region. I think the good news is that we don't actually expect there to be widespread defaults. And this is because the majority of countries that have faced rising public debt burdens across Sub-Saharan Africa have actually been quite responsive to the crisis. So many countries, including Angola, Kenya, Ghana, either have already engaged with the IMF through financing packages, or they are in the process of engaging with the IMF. So they really are taking quite active steps to making sure that their debt is more sustainable. It is worth noting that Mozambique already defaulted on its debt a few years ago, but we don't really see there being a sort of mass wave of defaults across the region. But it is worth noting that we are expecting weak public finances to continue across the region well into 2021. So we are expecting higher taxes across the board, weaker public spending, and slower investment into infrastructure projects. So although we don't see defaults, certainly a lot of fiscal pressure is likely to remain over the coming months.
Well, we'll see how that plays out eventually. We appreciate your time, Matt.
Thanks very much.
Global ratings agency Moody's Investor Service has affirmed the African Development Bank's AAA credit rating with a stable outlook. In an annual credit analysis, Moody's said AFDB's credit profile is supported by robust capital buffers and superior risk management, which mitigates risks. AFDB President Akinwumi Adesina said the AAA rating by Moody's validated the strength of the bank's prudent financial and risk management and strong governance systems in the face of challenges imposed by COVID-19. He says the extraordinary support of the bank's shareholders boosts its capacity to finance African countries. According to him, the bank will continue to manage risks and capital requirements adequately to help African countries to build their economies back. And a new report indicates that a small percentage of the money invested in climate finance globally is targeted at small-scale farmers in developing countries who already suffer effects of climate change. The UN's International Fund for Agricultural Development is now pushing governments to ensure that small-scale producers receive funding and the support they desperately needed to adapt to a changing climate.
Less than 2% of climate finance goes to small-scale farmers in developing countries, according to a new report by the UN's International Fund for Agricultural Development and Climate Policy Initiative. The report found that just 1.7% of funds available to help tackle and adapt to climate change went to small-scale farmers in developing countries, despite them being disproportionately vulnerable to climate change. Higher temperatures, increased drought, and flooding continue to destroy crops and livestock, making it difficult for farmers to feed their communities and earn a living. Small-scale farmers produce 50% of the world's food calories. If they cannot keep producing food, global hunger will inevitably rise.
Honestly, this changing weather really scares me. The sun is scorching and clouds pass by quickly.
The Examining the Climate Finance Gap for Small-Scale Agriculture report found that climate change financing surpassed $500 billion for the first time in 2017 and 2018. But only $10 billion was earmarked for smallholder farmers. IFAD is calling for more climate investment to be directed at this vulnerable group, which will not just benefit the farmers, but the global community as a whole.
Climate finance directed at small-scale farmers results in the continued production of nutritious, affordable food for wider communities. This means that these are investments that help eradicate hunger, which are investments in global peace, well-being, and stability.
IFAD's Adaptation for Smallholder Agriculture program is the largest global climate adaptation program for smallholder farmers, which has already channeled more than $300 million to more than 5 million farmers in 41 countries.
And that's a wrap on the program. Thank you for watching. I'm Chimeze Obi. You're welcome.